If you are still holding out hope your clean energy ETFs will replicate that doubling run we saw in 2020, or if you are still glued to hydrogen startups that burn cash with zero revenue, you need to stop right now. You need to fundamentally re-examine your investment thesis. The rules of the market have completely changed. That green fairy tale Wall Street sold you over the last decade? In the face of a 4.5% federal funds rate and a 10-year Treasury yield hovering around 4.3%, that story has been shattered. Look at the current price action. Read Larry Fink's latest annual letter. Look at the net asset value of those ESG funds in your 401 that used to be the darlings of the market. You are going to confront a brutal truth. The capital markets are undergoing a violent repricing of the entire energy sector. This is no longer a moral debate about saving the planet. This is a hard-nosed battle for return on invested capital and free cash flow. Today, we aren't talking about environmentalism. We are talking about your money. We are going to break down why the oil majors, once treated as pariahs, have transformed into absolute cash cows. We'll discuss why nuclear energy has gone from hazardous waste to the holy grail for Silicon Valley tech giants overnight. And, most importantly, we will discuss how you, as a serious investor, should reallocate your portfolio in this environment of high interest rates, volatility, and deglobalization. Let's rewind the clock 3 or 4 years. Capital was dirt cheap. Interest rates were effectively zero. In that environment, capital had no cost. You could promise the moon. You could tell investors, we're building an offshore wind farm. We won't make a dime for 10 years, but we are saving the world. And investors bought it. Why? Because in a zero interest rate world, a dollar earned 10 years from now is worth almost the same as a dollar today. But when you crank the risk-free rate up to 4.5% or 5%, the valuation of these so-called long-duration assets projects that push profits far into the future collapses instantly. Most renewable energy projects are, at their core, high-leverage infrastructure plays. Wind turbines, solar panels, these require massive upfront capital expenditures. Capital expenditure. Their business model is actually very similar to a bond. You spend a huge amount of money up front, and then you collect a trickle of electricity payments over the next 20 years. When the cost of borrowing spikes from 1% to 6% or 7%, the internal rate of return IRR of these projects gets destroyed. This is why you see giants like Ørsted writing down assets, and why Siemens Energy is in trouble. It's not that the wind stopped blowing or the sun stopped shining, it's that the cost of capital, the denominator in the equation, got bigger and it swallowed the project's net present value whole. That is the first order effect. But the second order effect is even more interesting. It has forced the market to become radically pragmatic about the energy transition. Institutional investors, the smart money managing pension funds and endowments, are no longer buying the decarbonization at any cost narrative. The new keywords are energy, security, grid stability, and economic viability. This brings us to the first core sector of our discussion today, the renaissance of traditional energy. If I had told you in 2020 to buy ExxonMobil or Chevron, you might have thought I was crazy or unethical. The narrative back then was oil is dead and stranded assets, but look at them today. Their balance sheets are arguably some of the healthiest in the S&P 500. Why? Because the ESG movement of the last decade actually handed the oil majors a massive gift. It sounds counterintuitive, so follow the logic. Global ESG pressure forced oil giants to slash their capital expenditure. They stopped the frantic drilling for market share we saw between 2011 and 2014. They canceled expensive exploration projects and focused on core assets. The result? Supply was artificially constrained. Now, as the global economy, especially emerging markets, continues its rigid demand for energy, we are finding that there isn't enough capacity. This is classic capital cycle theory. When a sector is starved of capital and stops investing, capacity shrinks. What follows is high prices and exploding profits. Today's oil majors are no longer growth stocks. They have morphed into premier value stocks. Their strategy is clear: capital discipline. The money they make isn't being wasted on wildcat drilling, it's being returned to you via shareholder buybacks and dividends. What does this mean for your IRA? It means these companies offer an incredibly high shareholder yield. In a backdrop of sticky inflation and high rates, assets with this kind of pricing power and cash flow are the ultimate defensive weapon. Don't expect oil to spike to $140 like in 2008, but even with oil sitting in the t-shirt and close just 71, 80 range, their money printing machines keep running. However, being long on oil is just level 1 thinking. The real alpha lies in a sector that was once taboo but is now being placed back on the altar: nuclear energy. This is the main event. If you understand the current logic behind nuclear, you understand the energy landscape of the next decade. We are facing an energy trilemma. We need energy to be cheap, clean, and stable. Solar and wind are clean, but they are intermittent. What happens when the sun sets? What happens when the wind dies? You need battery storage, but that is astronomically expensive. More importantly, a massive new variable has entered the chat: artificial intelligence and data centers. Microsoft, Amazon, Google, these tech titans are frantically building data centers across America to train AI models. A single large data center consumes as much power as a small city, and this demand requires 24/7 baseload power. They cannot accept server downtime just because it's cloudy. Who can provide zero-carbon 24/7 stable baseload power? Only nuclear. This is why you saw Microsoft sign that historic deal with Constellation Energy to restart the 3 Mile Island reactor. 5 years ago, that was unthinkable. It signals that nuclear has shifted from a utility problem to a tech growth solution. The investment logic for nuclear is undergoing a fundamental re-rating. Historically, the market assigned low valuations to nuclear operators due to safety fears and decommissioning costs. Now, they are viewed as franchise owners of scarce assets. In the West, building a new nuclear plant is incredibly difficult, and regulatory approval is slow. This gives existing plants a massive economic moat. But it's not just about the power plants. We have to look upstream: uranium. The uranium market is experiencing a classic supply-demand mismatch. A decade-long bear market stalled global mining capacity. Major producers like Kazakhstan are facing supply bottlenecks. Add to that the geopolitical angle, specifically the West trying to wean itself off Russian-enriched uranium, and you have a recipe for a supply squeeze. This isn't just a commodity cycle story, it's a national security story. When the U.S. government starts allocating funds to subsidize domestic enrichment, the wind has changed. So, the diagnosis is clear. High interest rates popped the cheap renewable bubble. Energy security and AI demand have resurrected traditional energy and nuclear. How do we build our playbook as investors? We need to avoid being the bag holder who realizes this too late. Do not chase small cap stocks just because they have nuclear in the name. Do not panic over daily oil price fluctuations. We need to build a fundamental, long-term, inflation-resistant energy portfolio. Part 1. The core position. This is your ballast. You want integrated oil and gas majors with an extremely low break-even point. You aren't looking for debt-laden shale speculators. You want giants like Exxon or Shell that generate free cash flow, whether oil is at $60 or $90. When analyzing them, don't just look at PE ratios. Look at free cash flow, FCF yield. In a 4.5% risk-free rate environment, if an energy company's FCF yield isn't over 8% or 10%, there isn't enough margin of safety. Watch their capital allocation. Are they blindly expanding or buying back stock? In this macro environment, buybacks often create more shareholder value than drilling new wells. This part of your portfolio provides the cash flow to hedge against geopolitical spikes. Part 2, growth offense, the nuclear chain. We take a two-pronged approach here. First, the physical fuel. Uranium miners. Cameco CCJ is the leader here. Think of it as the Saudi Aramco of nuclear. It has the best mines and long-term contracts. In this sector, liquidity is king. Do not touch penny stocks with $20 million market caps unless you can read a geological survey. Otherwise, you are just gambling. For most, ETFs like URA or URNM are safer bets to diversify operational risks like floods or strikes. Second, the operators and tech providers. Look at companies like Constellation Energy, which owns the largest fleet of nuclear plants in the U.S. The logic is simple. Every kilowatt hour they produce now commands a premium. Big tech is willing to pay extra for green and stable electrons. This changes the valuation model for utilities. They used to be widow and orphan stocks, slow growth, steady dividends. Now, utilities with nuclear assets hold the energy ticket to the AI era. Also, keep an eye on small modular reactors. While companies like NuScale have faced setbacks and volatility, SMRs are the only long-term solution to the high cost and long construction times of traditional plants. Treat this like venture capital. Keep the position size small, keep your mindset steady. It's likely a 0 or a 10x play. Part 3. Grid infrastructure, the overlooked goldmine. All energy transition, wind, solar, or nuclear, must travel through the grid. The average U.S. grid infrastructure is over 40 years old and aging rapidly. The reality is, the more we electrify EVs, heat pumps, data centers, the heavier the load on the grid. There is a high certainty opportunity here. Electrical equipment manufacturers, companies like Eaton, Schneider Electric, and Hubbell, they make the transformers, switchgear, and distribution systems. Lead times for transformers have gone from months to years. This is a classic pick and shovel play. Whether nuclear wins or solar wins, the grid must be upgraded. Their order books are full through 2027, making them incredibly resilient to economic cycles. Part 4. The minefield. What to avoid. This is equally important. Be extremely wary of solar installers and wind developers whose survival depends entirely on government subsidies, like the IRA tax credits. In a high-rate environment, their financing costs devour their margins, and they face the risk of funding dry-ups. Check your clean energy holdings. If a company needs to constantly issue shares to keep the lights on or has debt maturing in the next 2 years that needs refinancing, it is a ticking time bomb. In 2021, we could pay for dreams. In 2025, cash flow is oxygen. Without oxygen, the dream dies. And finally, be extremely cautious with hydrogen. Long term, it has potential. But right now, the economics of most green hydrogen projects simply do not work. Even with subsidies, the cost to transport and store hydrogen is astronomical. Unless you have a 15-year venture capital horizon, this is likely dead money in the public markets. Let's zoom out. Why am I spending this time telling you this? Because I want you to understand that investing isn't about what should happen, it is about what is happening. Many people bring strong emotions to energy investing. I hate oil because it pollutes. Or, I love solar because it's cool. Emotion is the enemy of investing. The market is a cold, hard weighing machine. In this era of high rates and geopolitical friction, the market rewards assets that offer security and certainty. Traditional energy offers the certainty of cash flow. Nuclear offers the certainty of baseload power. Grid equipment offers the certainty of infrastructure upgrades. Meanwhile, aggressive green projects reliant on the fantasy of low interest rates are experiencing a brutal valuation reality check. This doesn't mean the green transition is over. It means it has entered a mature, pragmatic phase. Just like the dot-com bubble burst, Amazon and Google survived, Pets.com died. We are going through the debubbling of the energy sector. The companies left standing will be the ones that actually make money and solve real problems. As an investor, your job isn't to be a crusader for a cause. It is to identify macro shifts and stand with the winners. If you heard something new in this video, if you're realizing your investment logic might need a tune-up, then I've done my job. Remember, on Wall Street, the 4 most expensive words aren't, "This time is different, but I thought that." Don't just think, verify the data, read the earnings reports, follow the cash flow. The next few months will bring more volatility, especially with geopolitical tensions rising. But I believe if you stick to this theme of pragmatic transformation, your portfolio will stand firm in the storm. If you found this deep dive helpful, hit that like button. It helps the algorithm push this hardcore analysis to serious investors like you. And in the comments, tell me, are you still holding on to solar, or have you quietly started buying oil or uranium? I'll see you in the comments. Stay rational, stay pragmatic. That's it for this episode. See you next time.